Why are the markets going sideways while gold has added more than $11 trillion of market value in under 1 year? Is it possible that everyone's getting the wrong idea about this historic rally? There is possibly more truth hiding beneath these headlines. While the initial assumption is that gold is a flight to safety, the real incentive seems to be something else entirely. And once you see it, you'll never view the gold rally or the Bitcoin dip the same way again.
So about 1 year ago, Bitcoin was at like $70,000.
Yeah, I
so
know.
it has still had incredible performance. If you go back to 2020, it's up 1,500%, right? So one of the things that I like to do is I like to take assets and denominate them in Bitcoin. So anyone can make money when you compare it to the dollar. The dollar only goes down. And so if you look at stocks, the S&P is up 100% since January of 2020. In Bitcoin terms, it's down 88%. So while stock investors think they're winning, when you compare it to a finite asset that can't be debased, they're actually down significantly. When you look at gold, similar story. Gold is actually up about 150% since January of 2020. But when you denominate it in Bitcoin price, it's down 84%. And so again, it kind of comes back to this idea of what is your hurdle rate? Are you trying to outperform dollars or are you trying to outperform a finite asset? For me, I think of Bitcoin as the hurdle rate. And as many people know the hurdle rate, if you can't beat it, I think you got to buy it.
Pomp nails it here. The S&P and gold may always go up when you're pricing them in dollars, but when you price them in Bitcoin, since January of 2020, the S&P is down 88% and gold is down 84%. Bitcoin is now becoming the hurdle rate. And like Pomp says, if you can't beat it, you gotta buy it.
Oops, winning.
So yeah, gold looks strong, but only in a system that keeps inflating the ruler we measure it with. And that's exactly where this story begins. As of mid-October of this year, 2025, gold has surged roughly 50 to 60% year-to-date in US dollar terms, hitting record highs above $4,300 an ounce. Meanwhile, Bitcoin is slowly becoming the stable coin of the year. Isn't that scary? I mean, it is October. Recently, it's going as far back as $104,000 a coin. Its return this year is in the low double digits, and much of its earlier gains have been surrendered. So, if gold is exploding and Bitcoin is stalling, you'd expect a broad hard asset rally, maybe real estate, commodities, everything. But so far, that doesn't appear to be happening in a significant way. The evidence is mixed at best and more of a vibe shift than clear data. For example, real estate isn't erupting like you would expect if this were the case. According to Realtor.com's August 2025 monthly housing market trends report, active listings are up over 20.9% year over year. Pending sales are down 1.3%, and homes are spending about 60 days on the market, which is actually a week up from last year. The national median list price sits around $429,990, flat year over year and down 2.2% month over month, a sign of cooling demand. Meanwhile, Newsweek reports that more than half of the U.S. states are seeing price declines, calling it a deflationary vortex in housing. Translation: housing, what our parents told us is the most hard asset, doesn't really seem to be joining the gold rush. Supply is rising, demand is cooling, and price growth has stalled, especially when you take inflation into consideration. What you're seeing instead is emotional FOMO, or fear of missing out. People rushing into shiny things when the easy upside appears. In other words, when gold runs 50 to 60% and Bitcoin doesn't, that's not a flight to safety story. It's a crowd chasing perceived winners. Consider the setup. Central banks signaling possible rate cuts, fiscal deficits ballooning, real yields compressing. With that, greed gets triggered. And this matters because we're setting the stage for something deeper than a cyclical rally. We might be witnessing the tail end of a major rotation. Now let's go beneath the surface. What if the gold rally isn't the real signal, but just one sign among many? What if what really matters is what the big players are doing?
Our Bitcoin IBIT is now over $100 billion.
$100 billion, I know,
so
from nothing not that long ago.
And 2 years ago, zero.
Yeah,
so
I know. Well, you weren't always a huge proponent of crypto, as we know.
Yeah, but
love it now.
But I grow and learn.
I heard you say that on 60 Minutes.
I did say that.
Governments around the world are seizing Bitcoin via law enforcement and regulatory action and parking that Bitcoin in self-custody. And that's true. They seized $15 billion worth of crypto from a Cambodian scammer operation, and it doesn't look like they're planning on returning that to the victims anytime soon. Not in Bitcoin, anyway. Meaning, the seized Bitcoin stays on the US and UK government's balance sheet.
What is this? What is this? Where's all the money? That's as good as money, sir. Those are IOUs. Go ahead and add it up. Every cent's accounted for.
Whether by design or simply the path of least resistance, this creates a sovereign Bitcoin accumulation mechanism, budget neutral to them and massively significant for their stack without changes in supply necessarily, hence the sideways price action. If that's happening in the shadows, then the visible gold run may be more of a side effect of the same greed impulse that drives Bitcoin. But the accumulation game has quietly shifted. Perhaps because the government has realized the true scarcity of Bitcoin. They've been watching Simply. Again, I'm not saying a government is running a Bitcoin accumulation playbook on purpose, although that's kind of what the Bitcoin Strategic Reserve is, but I digress. I'm simply saying the incentives seem to align with that outcome. And we've seen it before in the past with gold and the 6102 order in 1913. And smart players like Michael Saylor and Larry Fink have long taken notice. In short, while most chatter is about gold being the safe haven, the bigger story is that Bitcoin is being quietly stacked while most people possibly chase a red herring.
And the fact that we have gold at an all-time high, it means that the Bitcoin bull run hasn't even started.
Let's go.
Yes, because what happens, this is a study I published in June 2024. If you check my highlights, it was really clear to me that gold is the first responder to the quantitative easing. Because who the investors of gold are the investors in gold are people who know scarcity, who know that something has been the best globally, and also gold is a global asset. So they invest there because they have an old mindset, and they want to secure their wealth and their historic gold because that's what they've learned for. So they see the quantitative easing as a risk, so they move into gold. So that's why gold is a fast responder to quantitative easing. That's what starts to happen now. And after gold peaks, which it didn't, but then the risk appetite of investors moves towards Nasdaq stocks. So they want bigger returns. They want to this liquidity which has been printed before. They want to deploy it in a riskier asset, mostly because gold is already up a lot, and also because there is some more liquidity coming. So as a cascade goes into Nasdaq and the stocks. Then after Nasdaq goes up and stock goes up, then is the turn of Bitcoin, which is the one with the most intrinsic leverage of all assets, which is the one with the most volatility still, and there's going to be also for a long time. And the volatility, only the smartest can see it is a feature to beat inflation, to beat the quantity of easing and the quantity of money printed. So there is a natural selection happening here. The smartest go into Bitcoin before the others.
This is where things get reflexive. The same greed that sends retail into gold sends institutions into Bitcoin. And this is something I've personally experienced with friends and family. Every time Bitcoin goes up, I get the call. So tell me more about this Bitcoin thing. Seriously, it's like every Thanksgiving and Christmas. And sometimes on New Year when they've had a little bit too much to, It's human nature. People want in once the price moves.
What about me?
What about you?
Can you get me in?
You're not serious.
Oh yeah, I'm serious.
And that same psychology drives institutions too. The difference here is Bitcoin's absolute scarcity model adds an extra layer of urgency to the typical fear of missing out investors already experience. BlackRock, Fidelity, Schwab, Morgan Stanley, they are all expanding crypto access for clients. Meanwhile, ETFs are reportedly absorbing a significant share of new Bitcoin supply, and in some months, inflows may have even matched or exceeded issuance, according to BitGet and Farside. In game theory terms, this shows that investment products that track Bitcoin's price, derivatives, tokenized exposures, futures, I don't know what any of that is because I just buy Bitcoin, but may over time convert into hard Bitcoin if enough institutional demand shifts from synthetic exposure to true ownership. As institutional capital arrives, the narrative shifts from crypto is speculative to Bitcoin is the base layer. And that's when the feedback loop kicks in. And stacking now means possibly front-running what might be the next leg of this bull cycle.
Message!
Before we hit the final segment on Bitcoin's ultimate edge, let's take a quick break to talk about the companies building the foundation for this revolution. Would you mine Bitcoin if it were as easy as buying it? Then you should check out Sazmining. It's not hosted mining. It's mining as a service that actually puts Bitcoiners first. You can own a state-of-the-art mining rig, plug into affordable carbon-free energy, and just stack Bitcoin, just like Satoshi. No middlemen, no markups, and no worries. Saz doesn't tack on extra fees when you sign up, and unlike other companies, there are no rig upcharges or inflated power rates. Their entire business model is based on a clean and simple revenue share. They only earn Bitcoin if you are too. A total alignment of incentives and 100% Bitcoiner values. While some claim simplicity, Sazmining proves it. Let's just say that if you need a compass to find your miners, you're not in the right place. This is how Bitcoin mining should have always been done. Visit sazmining.com or scan the QR code to learn more and start hashing. And if you're not mining yet, but you're already stacking, there's another way to make your Bitcoin work for you safely. If you're stacking sats, you need Bitcoin-backed services you can trust. That's why we roll with Ledn, the global leader in Bitcoin-backed lending. Ledn has issued over $9 billion in loans since 2018 and a perfect record of protecting client assets. Why is a Ledn loan different? Collateral is not lent out to generate interest, no credit checks, funds in 24 hours, no monthly payments, repay whenever you want. 0 penalties, and their proof of reserves verified every 6 months keeps them transparent. Ledn lets you unlock liquidity without selling. Sign up through Simply Bitcoin for 25 basis points off your first loan. Learn more at learn.ledn.io/simply. Now, let's get back to the show.
Bitcoin is going to appreciate faster than every other asset because it is engineered to outperform. It's going to grow faster than the S&P. It's going to appreciate faster than gold. Sorry, Peter. I should say that again. It's going to go faster than gold. Sorry, Peter. It's going to grow faster than real estate or collectibles or anything else you can imagine because it was engineered that way.
Here's the crescendo, the moment I've been building up for throughout this entire story. Ready? Scarcity. Geologists recently reported discovering what may be one of the largest gold deposits in the world. A reminder that gold supply can still expand when new discoveries are made. Gold is marketed as scarce, but new mines keep opening, recycling flows, and overall supply continues to grow. Does that rhyme? Am I a rapper? No. I'm barely Dr. Seuss. Bitcoin, fixed cap, 21 million, predictable halvings, decentralized custody. My prediction is that once the rest of the world catches up to what we've all known, that Bitcoin literally can't be printed, that might be the moment the price explodes. And how would that happen, you ask? Phase 1, greed chases gold. Phase 2, understanding chases scarcity. And that's when the rotation hits, or as I like to call it, phase 3, absolute world domination.
The same thing we do every night, Pinky. Try to take over the world.
And before we wrap, Mining Disrupt 2025 is almost here and you don't want to miss it. The biggest Bitcoin mining event of the year is taking over Dallas, Texas, November 11th through the 13th. This may be the most important Bitcoin mining event in history. The biggest names in the industry, cutting edge rigs, Bitcoin and AI integration, the signal you won't get anywhere else. Grab your tickets today and use promo code SimplyBitcoin for 20% off. And we'll see you there.
The real problem with gold is that, unfortunately, it has to centralize. The problem is that gold can't achieve transaction finality without the help of a government or a central party, meaning that when gold was operating in a local economy, and you can exchange the physical coins with your direct counterpart for your butcher, your local tailor, your grocer, whoever you were exchanging with, gold was great. When the world needed to scale an economy and the velocity of money larger than your local economy, gold failed us. Gold failed us because gold is just a bare physical metal. It does not carry a monetary network. What's the gold network? The gold network are human beings. And when you're trying to transact in an economy of billions of people globally, you are reliant on central parties, banks, governments. And it was for that reason that gold failed. And it failed in a way that you can't operate a truly free market when the concentrated supply is with those that you have to trust. And so that's fundamentally what Bitcoin solved, is that you are able to create a scarce bearer instrument and a network that can achieve finality in transactional settlement without the reliance on any government or central party. So that, I think, is extremely, that's really the core issue of why gold's been demonetized since. I think on the points of Bitcoin like needing more history and it's young, I mean, I think that sounds like a personal problem for you, Peter. Like that, I think you need more evidence. And that's you being slow to recognize reality, right? Like if you were to need the internet to prove that email is better than traditional mail, you would just be late to adopting better technology. That doesn't sound like, that's not a point or a criticism against the properties that Bitcoin has. That's your own personal bias of how much proof that you need to adopt something that might be superior. So that's on you. And the last thing I will say on Bitcoin's volatility, for the listeners, I really think it's an important fundamental point. Risk is not the same thing as volatility. Risk refers to the probability of a permanent loss of capital. Risk would be that the Bitcoin code or the Bitcoin network outright fails. You can make an argument that Bitcoin's actually the least risky asset ever because it's the only asset you can store in your head. Bitcoin is, however, extremely volatile. And I will admit that, but that's a pro. Volatility is the frequency or like the magnitude of which the price fluctuates. And so Bitcoin, hold on. I'm almost done. I promise, 30 seconds. The point here, David, is that Bitcoin has to be volatile because the asset is inelastic. Because the asset cannot, with more demand in Bitcoin, you cannot make more supply. More demand has to fundamentally be a higher price. Whereas for all other commodities and all other assets, with more supply, you can make more demand, which makes them less volatile, but also makes them, I just went over the returns in the data, which also makes the returns not nearly what we're seeing in Bitcoin. So Bitcoin volatility is baked into the system because it's a fixed asset. So as it becomes adopted as a money globally, volatility is implied, but volatility is also the only reason that Bitcoin's averaging 100% year over year growth over the last decade, and gold's at 2%. So, and volatility is not risk. Because Bitcoin's volatile, it doesn't make it risky. It makes it an opportunity.
These last couple of weeks, it seems that everyone has been chasing what's already gone up. Gold looks like the winner for now, but the real greed play, accumulating what can't be printed, what can't be inflated away, what's out scarcitying gold. There's only one asset in the world that's designed to do that. And right now, it's Bitcoin. When people finally wake up to this reality, there possibly won't be enough Bitcoin to go around. And that's not girl math, that's just purely numbers. Anyway, that's the end of my show today. I'm Sophie. This is Simply Bitcoin's Satoshi. As always, remember to smash the like button, share this show with your friends, and turn on the notification bell so I can annoy you with more facts and hopium. Maybe drop us a comment below. How hard are you stacking this dip? And as always, stack, slay, and stay bullish, baby.